It's 3 a.m. in a reinforced vault beneath the capital city. No cameras, no press conference, no breaking news banner. Just forklifts and gold bars, stacked quietly onto pallets, sealed behind steel doors, recorded in ledgers most citizens will never see. While headlines debate interest rates and stock rallies, governments are buying gold at the fastest pace in decades. Not retail investors, not survivalist YouTubers. Central banks, the same institutions that issue paper currency, are accumulating metal. That should make you pause, because for years, gold was treated like a relic, a barbarous leftover from a pre-digital age, an asset with no yield, no innovation, no story. And yet here we are. In 2022 and 2023, central bank gold purchases surged to levels not seen in over half a century. Countries across Asia, the Middle East, and parts of Eastern Europe added aggressively to their reserves, quietly. So the question isn't whether governments are buying gold, they are. The real question is why. To understand that, you have to understand what gold actually represents. Gold is not just a shiny metal, it's monetary insurance. For most of modern history, currencies were directly linked to gold. Under the gold standard, paper money could be exchanged for a fixed amount of metal. Governments were constrained. They couldn't print endlessly because each unit of currency was tied to something scarce. That system officially ended in 1971 when the United States suspended dollar convertibility into gold. The world moved fully into fiat currency, money backed not by metal, but by trust. Trust in governments, trust in central banks, trust in stability. For decades, that trust held. Dollar became the backbone of global trade. Energy, commodities, cross-border transactions, most of it settled in dollars. Central banks held U.S. Treasury bonds as reserves. It was efficient, liquid, predictable. But the last 15 years have changed the psychology of money. The 2008 financial crisis shattered confidence in major banking systems. Then came massive quantitative easing, trillions of dollars created electronically to stabilize markets. Then a pandemic, even larger stimulus. Balance sheets expanded at record speed. Then inflation, the kind that forces central banks to hike interest rates aggressively. And then something else happened. Financial sanctions became a geopolitical weapon. When the West froze a large portion of Russia's foreign exchange reserves in 2022, it sent a signal to the rest of the world. Reserves are not just savings. They can be blocked. If your national wealth is held in another country's currency, inside their financial system, access is conditional. That realization changed the calculation for many governments. Gold, unlike foreign bonds, is no one else's liability. It does not depend on another country's promise to pay. It cannot be frozen if it sits inside your own vaults. That's the first layer. The second layer is inflation. When inflation surged globally after the pandemic, it exposed a vulnerability in fiat systems. If central banks expand the money supply too aggressively, the purchasing power of currency erodes. Gold historically acts as a hedge against that erosion. Not perfectly, not always immediately, but over long time horizons, gold has preserved value across wars, regime changes, and currency collapses. Central banks understand that history very well. Now let's talk about the uncomfortable math. Most central banks hold reserves in a mix of assets: foreign currencies, government bonds, and gold. If a country holds, for example, 60% of its reserves in dollar-denominated assets, it is heavily exposed to U.S. monetary policy. If the Federal Reserve raises rates sharply, bond prices fall. If the dollar strengthens, trade balances shift. If sanctions are imposed, access could be restricted. Diversification becomes more than a portfolio strategy. It becomes a sovereignty strategy. Gold's share of global central bank reserves has been gradually rising after decades of decline, not because governments expect a return like a tech stock, but because gold reduces dependency. Here's the irony. Public discourse often frames gold buyers as paranoid, but central banks are not emotional investors. They move slowly, strategically, conservatively. When they increase gold holdings, It's not a trade, it's a signal. A signal that the current system, while functional, is not invulnerable. Now contrast that with the public narrative. Retail investors are told to focus on equities, on innovation, on growth. Gold is described as outdated, non-productive, a hedge for pessimists. Meanwhile, governments, the architects of the monetary system, are increasing their physical reserves of metal that pays no interest. That tension should be interesting. There's also a longer-term shift underway. The global economy is fragmenting. Trade blocs are strengthening. Regional alliances are deepening. Countries are exploring trade settlement in local currencies rather than dollars. None of this dethrones the dollar overnight. The dollar remains dominant, but incremental shifts matter. If more trade is settled outside the dollar system, reserve composition changes. If trust in global financial neutrality declines, neutral assets gain appeal. Gold is politically neutral. It doesn't belong to a rival nation. It doesn't carry counterparty risk. It just sits there, quietly. Now consider debt. Global debt levels are at historic highs. Governments are running persistent deficits. Servicing that debt becomes more expensive when interest rates rise. One historical way governments have managed high debt burdens is through financial repression, keeping interest rates below inflation, allowing the real value of debt to erode over time. That environment is not friendly to bondholders, but it can be supportive for hard assets. Central banks know this history. Many of them lived through past cycles of currency instability. So when they buy gold, it's not necessarily a bet on collapse. It's a hedge against miscalculation, against policy error, against geopolitical escalation, against the slow erosion of trust. There's a subtle absurdity here. The institutions that create fiat money are accumulating an asset designed to limit fiat excess. It's like an architect quietly reinforcing the basement while publicly praising the skyscraper. They may fully believe in the structure, but they're not ignoring gravity. Long term, what does this mean? It doesn't mean gold is about to replace the dollar. It doesn't mean hyperinflation is inevitable. It means the monetary order is under quiet stress. Multipolar politics, high debt, weaponized finance, inflation shocks. Gold purchases are not panic, they're precaution. At scale, tells you something. When central banks collectively move in one direction over several years, it reflects structural thinking, not headlines. So the next time you see gold prices move, or hear that another country added tons to its reserves, don't think in terms of shiny metal. Think in terms of trust. Think in terms of optionality. Think in terms of a world where financial power is less centralized than it was 20 years ago. Because beneath the surface of modern digital finance, beneath algorithms, derivatives, and trillion-dollar bond markets, forklifts are still moving bars of metal into vaults. Not loudly, not dramatically, just deliberately. And if the institutions that design the global monetary system are quietly preparing for uncertainty, what exactly are they preparing for? If you want to understand how money really works, subscribe now.